Okay, here we go. So this afternoon, we're going to be talking about basically chapter 3. And that would be then assignment 2 and homework 2. Most of this we've already covered, but I'm going to cover the stuff that's very, very difficult for you because I often get questions on this, and this is very technical. Again, I know that the basics can be a little bit boring, but it's very important to understand how you look at these analyses so you can deal with different things. And let me just give you an example. For me, for example, when I'm in real estate, I have very lumpy investments. I basically buy a house. So it's not as if I can just get $2,000 and put it in something. I actually have to have a very large down payment because you get much lower rates as a rental property person if you have larger down payments. So you have to amass a bunch of money. So there's a lot of like incremental investing in other things besides real estate. And then the investment in real estate is very lumpy because it takes a large sum. And that's what you'll find with most businesses. They have what I call lumpy investments. So that means you can't just put in $500 here or $500 there. And particularly for community and government projects, they're very large upfront costs. So we have sometimes a lot of problem because you'll be comparing one project over here that's a big budget but has a different time frame than this one over here, which has a shorter time frame but maybe a smaller budget. So trying to actually make some of these comparisons across options are difficult. And I'm just going to warn you right now, the reality of the situation. Most people think these big, large, flashy projects are the way to go. If you drive around Oahu, what do you see? Big project. This was done by the mayor, or this was done by the governor. Very expensive, large projects. And if you look across UH, what do they love to do? They like to build buildings, but do they like to maintain them? Small projects often do not get done because most, particularly in the nonprofit and government sector, they like these big flashy things. So this is very difficult. And as we're looking at dealing with our current global climate change issues and all of our social, very large social issues, these may take some very large long-term investments. And so this is why we're going to talk about this particular PowerPoint today. Oh, there's a chat. Oh, Alexis is laughing at me. Thank you. We try to be funny because otherwise this class can be a bit tedious with all these numbers. So we're going to share the screen and start on this first PowerPoint as soon as I figure out where it is. Here it is. You see how much I have going on. I need a bigger screen. I cannot be working on a laptop. So we're going to, okay. So here we go. So I didn't go back. Okay. So let's talk a little bit about this kind of issue that I brought up about, well, we got these public funds or we have private funds and how are we paying for things? Okay, this all matters. If you're doing a private investment, then you heard me say that I have a down payment and they borrow the rest of it. So when you're doing a CBA, when you're using debt financing, which means I borrowed the money, that is really a financing decision. That is not a project related decision. So sometimes people will get very confused in this class, particularly if they're not business majors, on what about, because you hear the word interest rate, what are you all thinking? Borrowing. That's not what we're talking about here. Borrowing in this class really becomes a cost of capital. So if I'm borrowing, I am basically going to a bank, and that is just a decision on where I'm going to get the money to do the project. So that's kind of a little different definition of some of the situation. And we also get confused about what the word capital means. What is capital? Now, in this class in finance, capital just tends to be, no, I wonder where that came from. Anyway, so in this class, capital really is kind of a source of funds. It's a source of funds that you get. So that's different than assuming it's an actual asset that economists think capital. Economists think of capital as a resource that, you know, that's a capital investment. So that's an investment where we're investing in a resource like a building, and then that building is going to produce things. So we have a lot of nomenclature problems that we may run into. And part of it is that the finance definitions may not be the same as the economic definitions. But when we're talking about debt financing, we're basically saying debt financing means we borrowed the money. It's not going to show up in a CBA. That's going to show up actually when you analyze your profitability. So when I analyze my profitability, I can make a lot more money if I borrow money. Why might I make a lot more money if I'm using borrowed money? Anybody have some suggestions? Because in my business, I'm shooting to make 17% on every investment I make. Do you think I'm going to borrow at 18%? No, I'm going to borrow at a much, much lower rate. So my highest interest rate I think I have on loans is a 3.8%. And if I'm making 17%, I'm borrowing money at 3.8 and I'm turning around and earning 17% on it. It's not my money, but I'm taking that margin. So this is a very important issue when you come to private investors and are trying to work with them on their BCAs or their CBAs. So that's important. But either way, it's still a source of funds, borrowing, and you need all the capital to make the investment. I can't buy the house unless I have all the capital. Now, it becomes a little more thorny when you're using public funds. Why is that? Because public funds usually are totally financed by the government, but sometimes the government also may issue government bonds, or you may have a school district that issues a bond. So you have to remember when you're dealing with those, if you ever do those types of BCAs or CBAs, that is again a financing issue. So you have to understand, because a lot of people will want to go in there and put in that cost of financing. That is only relevant is if it's a tax deductible expense. If it's a tax deductible expense, then it reduces my taxable income and we treat it differently than if we were just spending our money. So you have to kind of understand that, because we're going to talk about in the next chapter how we handle things that change tax deductible expenses. And it's going to be confusing because private people can deduct tax deductible expenses, but governments cannot. So if the government issues a bond to build a new school, we're not going to do anything with that debt. You just got to make sure you have the cash flow, but it's not really related to the profitability of the project. So that's another thing you would have to worry about if you were working with that individual looking at the CBA. You also have to make sure that they can pay back the debt, but that's totally different than the profitability of the project. Paying back is different than profitability or actual return from the project. So this is difficult if you are not very experienced at a high level in accounting and economics and finance. So that's why we're talking about it, and it is going to come up in the next chapter. But it's kind of mentioned in this chapter, they start talking about equity capital. What the heck is that? That's the owner's money. I use my own money, right? That does also have an opportunity cost, and that opportunity cost should be reflected in your discount rate. However, the cost of using borrowed funds is given to you by the lender, that interest rate. So, and my last word on this thing, which is relative to your personal finance, when you charge things on your Visa card, remember that you're going to be paying for that. So that interest rate should really, that you're going to be paying if you don't pay your balance in full every month, be sure that you're not spending it on things that are gone. Really think of it like I'm investing in something when I'm using this credit card, because you may be paying for a lunch that you had 5 years ago for a very long time if you borrow the money to do that. So if that's not something that's going to produce long-term well-being, think about that before you pull out your credit card, because you're going to be paying a very large rate. Most credit cards are at least 8% for having current consumption and not waiting. So that dictates to you the cost that you incurred by not waiting. And there's my message that I try to give out in order to get people to be more willing to wait and not so quick to pull out their credit card and run up big credit card bills. Only because in the 60s, we never did that. When I was young, we never used credit cards, didn't use them. But now we're very reliant on them, and it's creating a situation, particularly with student debt, where you're paying this off at when you're 45 years old, and has it really been an investment? If it's not an investment, don't kid yourself. If you want to buy a boat, that's not an investment. The thing wears out. Unless it's making you money. You want to buy a car, it's not an investment. It's a personal expenditure. So you really need to be careful how you use these words and what we're really talking about here, because for personal and business finance, this all matters, and they obsess about it in business. What's the cost of our own money? What's the cost of borrowed money? And for economists, the additional thing is, are there any other opportunity costs besides the fact that we're not able to use our money because we've now invested it over here, or we've spent it on some consumables that are gone by the end of the year? So anyway, enough on that. It's a very funny thing, but as you get into this, you'll hear these words and you will get confused. Oh, I keep forgetting about that. Okay. So whether debt capital or equity capital is used, the cost of capital still remains in a CBA as the discount rate. And again, debt capital is less expensive, but it's very, very risky. Okay, it's very risky. So at that point, you may want to consider some sort of risk thing in your CBA if they're really borrowing a lot of money. And in fact, we have had, didn't Detroit go bankrupt? I think so. So that, and let me just say, with all this money we're spending for the pandemic, some people are very worried about all this debt because we got to pay it back. So these are some of the things that we have to worry about. So in general, operating costs for a business represent the cash costs, not the cost of financing. And then we're going to also have something I think we're going to talk about next time called depreciation. But I think it's in homework 4, so we're not going to talk about it today. What I really want to talk about today, you know what, I'm thinking this may be the wrong PowerPoint, because let me stop the share for a minute and check the PowerPoint, because it doesn't look right. Now I don't even, well, maybe that is the one. Anyway, so we'll talk about depreciation another time, but for private investing, it's really all about cash flows. Okay. So terminal values, you're gonna get an assignment in chapter 3 that talks about terminal values. So the reason we're talking about that is because sometimes you're comparing two investments and they don't have the same time frames. So it's very difficult to figure out which one you should do, or maybe you could do both. So sometimes the idea of an MPV is difficult to imagine, because if one investment is only 2 years and the other one is 5 years, they don't match up. So of course the 5-year investment might be expected to have a higher net present value because you got benefit for 5 years, but you're not quite sure because what's that initial investment? So they're difficult to compare. You can't just say an NPV of 6 is less than an NPV of 20, so I should take the 20. Sometimes that's not a good indicator, and let me explain why. What happens is when the money comes back, you have your first year, you get your money back in, as it says right here, you may, like me, not be able to then turn around and put it into another house that earns 17%. I need to amass a down payment. That sometimes can take me 5 years. Sometimes it can take me 10 years, depending on what else I got going on and what the cost of the property is. So this money comes in. If I assume that my cost of doing business or my opportunity cost of waiting is 17%, I can't assume as that money comes in, it stays at 17% because I haven't bought a new house with it. So I might park it over here in another account. And when I park it in this other account, then it sits there and earns a different interest rate. So this idea that I can discount at 17% as a private investor isn't accurate because I need to sit and accumulate in this holding account. So sometimes that's a problem. It doesn't talk much about it in your book because it doesn't talk a lot about private investing in your book, but in the BCA review, it does talk about it. So we have to kind of deal with those sorts of problems. And it also helps with comparing two projects with different time frames. So it helps when you know you're not going to invest it at the 17%, and it helps when you have different projects you're comparing with different time frames. So how do you do a terminal project or a terminal value? So if we had two projects, you know, if you look at this, you see one is returning very quickly and the other one takes much longer. So how might we compare these? And how might we calculate those NPVs? So you got to put this into your Excel table. And when you put this into your Excel table, this first one would not have anything coming in year 4. So you're only discounting for 3 years, right? So be careful when you put this in. It really ends after 3 years. So if you put a 0 here, it really is not something that's going to be counted, right? Because you multiply by 0, it's going to be 0. But this one is going to be different. If you need to put those zeros there because those are essentially a whole year when you didn't get anything. This one doesn't matter as much because this investment basically terminates at year 3. But this one does not. So you have to make sure that you put these zeros in here, or otherwise your answers are going to be all messed up. Does that make sense? And it also makes it harder to compare these because they're different lengths of time to actually figure this out. So let's just see what it looks like. So what we're going to do here is calculate a terminal value so we can actually compare. So we come up with something called the reinvestment rate. What is that? Well, when my money comes in and I don't have enough to buy my house, I put it in my parking place and I get a much lower rate of return than I get if I invested in a house. In this case, we're going to say it's 5%. Okay. And how do we compare these if as every year, as this money comes in, this gets invested at 5%. Nothing there, so nothing happens. This one gets invested at 5%. Nothing happens. This one, 5%. Here we have money, so that's at 5%. So sometimes you can get a better comparison if you move everything to year 4. And how do you do that? Again, we're just moving money around, and we're moving it not at the discount rate, but at the reinvestment rate, because as it comes in, we're not putting it into new projects. We're not putting it into anything. We're just parking it because we need to amass and accumulate enough money. Again, mostly for private investors because this is what they run into. So sometimes we do the terminal and we move everything to year 4. So for the first project, that would be how you would do it, to move it from year 1 to year 2, year 2 to year 3, year 3 to year 4. And then the second project, the only thing you have to do is move this one right here to year 4. So did I make a mistake? I think so. I'll change this when I put it. We got an extra 800 here. But you can do this on Excel. You can move money into the future using the reinvestment rate. And if years 0 are different, then you can move it back to year 0 using the discount rate. And that's kind of what you do. As messy as that sounds, that's what you have to do, simply because when the money comes in, you don't have another project ready to go. And for small businesses, they do not have another project ready to go. They park it at another rate. And if you try and discount using your discount rate, you're not going to come up with accurate information. So I know it's very technical, but okay, that was the wrong one. So let me try one more time to do a screen share. Okay. Okay, let me try to, I'm pretty sure I had another one here. Let me see, maybe I relabeled it. Here we go. Okay. Okay. So let's screen share that one. Sorry. Talking water and sewer people. He couldn't come at any other time. And there it is. Okay. So, oh, that is the right one. All right. So that's what it looks like. So let's go to the Excel, because apparently I was wrong, but let me stop the share. I thought I had another problem on there so we could see it more clearly, but I don't. Okay. So here's our Excel sheet that I made up to show you how this looks like. So we're going to start right here with projects A and B. So, and you've got like 3 or 4 problems like this. So this is why we have this example. So we have project A. Let me blow it up. Project A, $50. Project B, $50. In this case, I put parens around it because it's a negative. So project A returns $60 the first year. Project B returns $105 in year 5. And again, you have to put in the zeros or it's not going to work, because this will basically read for project B as if it's only 1 year. If you don't put in zeros, you have to put in zeros here. In these cases, I think this works is a 0. It just doesn't look like a 0, but if I click on that cell, it is a 0. So when you do the NPV, which I have done right here for you, the NPV for A at a 10% discount rate is $4.55. At B, it's $15.20. Which one should we do? A or B? Well, you might be tending to pick B because it has a $15.20 NPV. But when you do the IRRs down here, we notice that A has a higher internal rate of return. So now we have this case that we talked about previously. Well, the internal rate of return differs from the NPV as far as ranking. NPV doesn't work real well for ranking because of this problem. But on the other hand, IRR assumes that you're getting 20%. As soon as you get this 60, it's assuming that you can put that somewhere else and get 20%. That's not necessarily accurate either, because when you're making a decision on projects for this business, you're always picking everything that earns 10%. If it earns more than 10%, it's fine, we'll take it. Does it earn 11? Does it earn 12? Well, if you make it using NPV, then you're only cherry picking 10 or higher. If you make it using IRR, the assumption that everything can be reinvested. For B, You have several years with nothing. That implies that somehow you're getting 16% on nothing. So that's difficult to process when you're trying to make a decision. Again, this is mostly for businesses. So what we're doing is we're going to come down here and we're going to move it to a terminal value. And the only one we have to move to a terminal value is A. B is already terminal. You only make $105 at the end. A is at the beginning. So we're going to move it to the end using the reinvestment rate. The reinvestment rate, 17%. We're going to just tell you, it's 17%. So you're here, then you move it to 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 here, and you would get 112.43. But if you were super efficient, you just get a future value here, right? You could just get into your financial formulas and calculate a future value to move it 1, 2, 3, 4 periods out to year 5, a future value of $60 at an interest rate of 17%, and you can move it to the future. So it's not that hard to do this, but it's a bit confusing, and you have several problems like that. So whenever you have them unequal terms, you try and move everything so it ends at the same time by simply moving it with the reinvestment rate. So for those of you who are not very sophisticated in Excel, this can seem complicated, but as soon as they tell you in the problem reinvestment rate, that means you need to move stuff around so everything is in the same time period. Again, mostly a problem because we need to worry about the lumpiness of investment, the fact that not all investments have the same timeframes, and you don't always have the ability to get that money in and stick it in the next project that meets that optimal decision as far as what is our discount rate. Not everything is out there immediately, and this is actually becoming a major problem now in the world today. I think Germany last year was completely stressed out because they had all this money in the bank and no one would borrow it even though the interest rate was really low. Why is that? Because there's no projects out there that look attractive. This is really a problem when you're trying to move forward with progress, and particularly projects that have a large non-market return, because a business may not be looking at that. And if you don't have businesses out there doing things, they're not paying taxes. And then if we don't have taxes, then we don't have the ability to do government projects, which then also are geared at helping the environment and helping the social structure of the community. That's the role of government and nonprofits. And it's a problem. And I think what I notice in natural resources and environmental management students is they're very interested in nonprofits, but the reality is if they don't pay taxes, then how do you keep things moving? How do you keep money being generated? So there is a concern always on how do you keep your businesses moving forward and able to find projects so they can invest in them. Because if we have no investment, we will not have any productive capacity for business in the future. Investment really generates productive capacity to produce net benefits in the future, and included with that is taxes, employment, all these things that sell well, but sometimes for conservationists or people interested in sustainability, they're not really looking on that as a goal that they have. So this really becomes challenging. I'm going to be really honest. It's very, very challenging, but you can work it into your CBAs to at least examine these things and at least get a better picture of what's going on relative to timeframes and what kind of returns I need to get businesses moving forward, what kind of reinvestment rates. And I'm sure you're all noticing that when we're talking about all these pandemic loans that went to these really large, well-established businesses. I don't think that was the group we really intended to help. I think the big controversy now is Kanye West got a bunch of money. do they really think that's a good idea? But that's what happens, is they have a large enough size that they can pull in that money and quickly get it into a project that pays, or get it into a situation where they can move it and keep going forward with their productive capacity. But when you're a really small operation and you're talking small amounts, it's very expensive to get in there and deal with all that. And it's difficult to think about productive capacity when you can barely make your payroll every week, all the time. Small restaurants, for example, very challenging, very, very challenging. Small businesses, they are very challenged to make their payroll. And when you try to talk with them about sustainability and all this CBA stuff, it becomes very overwhelming. But the majority of good jobs really come from small businesses. They're very important. They're very important to community. It's very important that we have local vendors. We want to support that, but it's very, very difficult when we start looking at some of these requirements of these CBAs and this amassing of capital in order to reach these goals is very complex. So this is kind of one of the disconnects we need to worry about, because as we saw with the economics lecture, what we really like is a lot of small buyers and a lot of small sellers, and that creates community in the market, and it also creates a much better situation from the point of view of efficiency. So this is what we have, because what really is everybody going for? Bigness, big companies, big unions, a big government. It tends to kind of happen, and these are one of the reasons why, because it's much easier to do these types of investing projects if you're big, because you have tons of projects all over the place. You have all sorts of people to analyze all this stuff. It's all a corporation, so you don't have to worry about the opportunity cost of the owner's time because they're all on salary, so it's all computable. It's much easier. You have someone that just sits around and does spreadsheets all day long, and accountants that generate data. And we see the effects of this in the pandemic, and all these loans going to people that are not really considered to be the ones that they were geared for. And this is going to be a problem. I think we're also going to be looking at problems when we start trying to mandate minimum wage. I think the impacts of that, we reduced a lot of restaurants. So any marginal restaurants, any unskilled workers, they're going to go for the skilled worker in the high-end restaurant that is really, really popular. So you're running a lot of marginal restaurants out of business. And a lot of it has to do with these sorts of ideas of interfacing to keep investment flowing. Again, this is all very private business oriented, but I want to cover one more thing, which is kind of thorny, that you run into in chapter 3 and on assignment 2. They want you to duplicate discount and annuity tables. Why are they doing that? Because they're trying to get everyone familiar with Excel. For those of you who are familiar, this is not hard because you just get the formula. So right here, you'll see the formula for generating this one, right? So this is a factor that you can multiply by numbers. Back in the day before we had Excel, this is how we did it. So the formula is right there on the discount table in the end of your book, back pages of your book, and the annuity table is there too. What was an annuity again, you ask me? Well, that's when you actually have the same amount of money that comes in every year. In this case, for 2 years, you notice it goes to 1.970. So this is 2 years worth of a dollar, where this is $1 with a 1% discount rate received in 1 year is going to be worth this today. This is that same dollar at a 2% rate. This is the same dollar at a 3% rate. So you waited 1 year for this dollar and it was at a 3% rate. And you see what the impact of increasing that cost of waiting does on the value of that dollar. And they're asking you to do this in order to get you more familiar with Excel. And for that reason, for the undergraduates, it's kind of sometimes difficult to vision because you may not understand these tables. So I've actually given you a formula, and you notice here, I have a $sign B2 what that does is it fixes it. If you pull this formula over, it always will fix on this number right here because it's always in year one. What's changing is the interest rate, which is up here. So this one, if you go here, then it becomes D, right? But it's fixing on what's in D2. So that's how you enter formulas in Excel so that you can kind of see what I'm doing. Same thing here. It's a little bit more complicated, but again, you notice you're always fixing on the year. The B one always has a dollar sign. The dollar sign will fix it, where this one with the C is going to this. So you can, it's just a exercise in practicing putting in things and getting these formulas going. But once you get that, you can just literally copy it and move it out. But you got to understand what you're fixing to. This one varies depending on the interest rate, where this one is always year one. So I'm going to post this so you can see it for those of us who are not as Excel savvy. And not a real long lecture here because chapter 3 really doesn't talk about much other than the reinvestment rate. And then next time we will cover what we need for, oh no, that's homework 4. Oh, I know, one more thing. Homework 2 is very simple, except for everybody gets hung up on the second question. The first question just asks you to calculate some IRRs and some NPVs. The second question asks you to investigate the return from going to college. So everybody always gets confused about that. So you really need to say to yourself, what are the opportunity costs of going to college? Working. And so you have to really say, I've got 2 options. I could work or I can go to college. So if you're looking at the return from going to college, one of the opportunity costs you will bear is not working for 4 years. And I'm sure everyone in college that isn't working is bearing that cost because you just can't work a full-time job. You're not going to get those funds coming in, all these sorts of things. And there's also going to be some timing problems. Do you pay tuition at the end of the school year or at the beginning? So you got to pay tuition up front, but you don't get your paycheck till after you work the hours. So that's another thing that enters in here that you need to worry about. The timing is very important. Do you pay it at the beginning of the year or at the end of the year? So this is some of the stuff that you have to think about. And as you do this problem on homework 2, there's only 2 problems on homework 2. The first one is just relatively straightforward. You just go into Excel and calculate what the IRRs and NPVs. But with the college example, think about how much paying more tuition reduces your return. Because most people do not realize that these large initial investments, such as a very expensive 4 years college degree, take a very long time to pay back. So unless that college was really fun, this is something that people are not realizing, that large investments take a very long time to be profitable. And this is something that you will now see as we talk about our student debt problem. Should we give students free college? Should we not? But why does one college cost so much more than another college? Is Biology 101 better at Stanford or UH? Because it certainly costs more at Stanford unless you're fully funded. How about biology at a community college, Biology 101 versus Biology 101 at UH? Much different prices. Is it different? So this is another thing you have to think about when you're doing projects of these options. People will tend to go for the big money projects. So will governments. Sometimes that's not a good decision. And as you do more of these NPVs, it takes a really long time to pay back large sums of money because in this example, an interest rate of 1% is not so bad, but as you get out here to a 12% interest rate or even a 7% interest rate, it takes a long time to get that to really pay positive. So when you're actually having a very large opportunity cost of waiting, which you do when you graduate from college and you need to get started and you want to go out there and really start getting your life set up, takes a long time to pay back that student loan. And that's another thing that we're thinking about as we're making these discount tables, to really think about the impact of spending large sums rather than trying to move to a more community-based, smaller impact type of a setting, like a community college versus a big Ivy League school. Not that I'm against Ivy League schools, but it is something that I often hear. What should I do? And so when you think about that college decision, this is what I'm trying to get at, is to make you really ferret out all those opportunity costs and real costs of this situation. So we're kind of done. Thank goodness it's Thursday, so nothing tomorrow, but we should be, frankly, able to get assignment and homeworks 1 and 2 done and handed in pretty quickly, because it's not that hard. And I promise you that chapter 1, which is for assignment 3 and homework 3, are much easier and don't even require Excel. So we'll talk about those next time. And let me just warn you, before you read chapter 1, I find it very confusing, and I don't think about it that way. I think about it like I've outlined in the BCA overview. So next week we'll talk about that. I think the way I think about it is very logical. So for those of you who are looking at doing assignment 1 and are reading your book, you might not want to read chapter 1. You might just want to read the BCA overview and try it from there. It's a lot more straightforward. Okay, anyone has questions? Okay, so we're gonna call it a day. Sorry to be so flaky, I was talking sewers. And we're gonna stop our share. I'm gonna upload these. Again, we didn't cover that much, and most of it has to do with the business stuff. So that may not be something that interests some of you. Okay, so let me know if you have problems. I'm working tomorrow, so I'll be checking my email. I'll be working on Saturday, checking my email. Sunday may be a little spotty, but Friday and Saturday, if you send me stuff, I'll try and respond and grade as quickly as I can. Okay, thank you so much for coming. Yes.
I got a question. So looking at the Zoom schedule, it looks like there is I just wanted to confirm, is there a class tomorrow at 12?
Is there? Let me check. I didn't think there was. Let me look at the Zoom schedule. I thought I just checked it and it wasn't. What happened, let me just explain what happened with the Zoom schedule. I gave it to this Allison and it came back and it wasn't what I asked for. Oh, there is tomorrow at noon. Very good.
I'm okay with rescheduling that. I don't know about the rest, but.
How are you thinking, Alexis? We're a little bit further ahead than I thought we would be. And the reason I think we are is because no one's showing up and asking questions. So my suggestion is we cancel tomorrow. Any opposition?
That's good with me.
So I'm going to send out an email to everyone that we're canceling tomorrow. Or if they want to work with me individually, because I have a feeling from what I'm seeing, the undergraduates are not quite sure yet what's going on. So they may need some individual attention. And then if either of you needs, I mean, I've been corresponding with Alexis and sending her things relative to what she's interested in. So if you have anything that you need, Jordan, you tell me.
Okie doke.
Again, because you may have more sophisticated needs. And another option, you can move ahead. There are other lectures posted from last year on chapter 1, or you can move on to chapter 4. It's very apparent how to do some of this stuff, like the depreciation stuff comes right out of the BCA overview. There's examples right in that written. So if you get it, just keep moving. You can proceed at any pace you want in this class. I'm happy to grade it, whatever. I'll answer any questions, whatever. But the problem is I'm running courses simultaneously. So the undergraduates are not moving at the pace that the graduate students need to move at. Does that make sense?
Yeah, I got a question actually. You had mentioned earlier about the stochastic analysis. Do you
Yes.
have any suggestions on resources that I could, like for this class, that I could use to try and prepare for that, so I can incorporate it into my final project?
Well, I would read that chapter, the chapter on
Okay.
risk. It actually describes how I think you can get an add-on for your Excel
Yeah.
that will actually help you estimate the distributions. Because what you're going to have with actual data, particularly for finance, it's not going to be normally distributed.
Yep.
And you can actually simulate using Excel. You can actually simulate the range at which the returns will vary over if you know the distribution, if you can estimate the shape of the distribution. So you don't have to have the traditional standard deviation, right? Because
Yeah.
that's for a normal distribution. I think for finance, that's a little bit ridiculous. Because who functions like that? Have I ever seen anything that's normally distributed? I don't think so.
Yeah.
Including what I go through with grades. I'm like, if everybody thinks they deserve an A, then doesn't it mean that the average performance? I don't understand. Not everybody can be above the mean, and
Yeah.
a C is at the mean. So how can everybody get A's? I mean, we get into this weird thing. So actually, you can do simulation, Monte Carlo simulation, where once you know the distribution, you can get Excel to go in there and say you run it 1,000 times. It will just go into distribution and pull a return out of there. And then it will give you the expected return, which for you, if you have big databases, this is very interesting and very easy to do on Excel when you do the add-on.
Okay, no. Thank you.
So go to chapter 9. I think it's chapter 9. It's the chapter on risk, and they actually describe it. I don't usually use it because I don't like to force people to buy the add-on.
Sure.
And it doesn't work with a Mac. Then you have to do parallels and convince your Mac it's a PC, and it gets very messy if you're not into these things. But I think for you, and I'm just going to say this right to you, using the word Monte Carlo kind of sells. It sounds so impressive. So when you're trying to publish and do your papers for professors, doing simulation is very useful, but it's not that difficult. You just need the distribution of that variable.
Yep.
That's all you need. And then you can go ahead and do that add-on, and then you can plug it into your Excel, and then the Monte Carlo will just simulate through that distribution, and it will come up with your expected return.
Perfect.
Pretty snazzy, actually.
Yeah, good. Looking forward to trying it
Yeah,
out.
you might be able to come up with a really nice project. I have used it with a student one time who was looking at raising shrimp. She created a shrimp production facility at the aquarium so she could feed these little shrimps to the animals, because it was a very pretty thing for the tourists. They would pay for the shrimp and then it would swim around and it would eat it, but it was very cool because the aquarium animal would move very gracefully and the shrimp was very small, so you didn't feel like you were sacrificing a life. And she designed a whole system, and we really proved that you could in fact be more sustainable at the aquarium by raising the shrimp. And then we looked at all different options, with prices on the mainland and how they varied for the shrimp because they were very difficult to get, and there was all these price variations. So we had to simulate a price for the imported shrimp to make our case that it was better, because you had to pay upfront for the construction of the feeding facility.
That's very cool.
So it was very cool. And I'm going to just say, we had people on the mainland watching the defense, and the committee said it was the best they'd ever seen. I mean, we had a one-word answer, yes, at the end of the day, but the simulation, how we looked at all the prices and really proved that local production was more sustainable, and we could actually document it by saying we could do it. And she literally worked for 2 years to invent the shrimp production facility, which makes her one of only 3 people in the nation who'd ever had built one of these things. She would come in with a broken arm, and I hit myself with the thing, and I broke my arm, and then we would be doing simulations to find out how these prices fit in and what was the distribution of the prices over time. It's very, very interesting.
Yeah.
So you can do some really exciting things, particularly for you because you're in business. Because they're going to be looking at databases of prices and costs, right? So they're going to vary. Mostly costs are more predictable, but prices jump around. I'm thinking it would be very interesting also for carbon offset stuff, because those markets are very messy. And investing in forests is very expensive, and that's why we have carbon offset markets, is to try and get a way so that people will invest in forests, because the NPVs will never pay out.
Yeah.
70 years to produce a koa tree, how are you going to get that to pay out? But if you can get in a carbon market and sell your stuff and get money back from carbon markets, then you might actually get a successful investment, because you actually have money coming in just for the fact that you're growing trees, not because there's a product. So it's a kind of a non-market good.
Yep.
Super interesting.
Very cool.
Okay.
Thank you.
Okay, bye. Have a good, and so I'll cancel tomorrow. I'll send out the email.
Okie doke. Well, have a good weekend.
Thank you for bringing that up, because I forgot I did that. I didn't think we could cover so much, but no one shows up, so I get a lot said.
Yeah.
Thank you.
Good.
Have a good weekend.
Yep. Bye.